Now, TNBC's beginning inventory purchases and sales of Never Stop energy bars for the period are here. So now what we're going to take a look at is a more realistic picture, because we all know that a store sells stuff, buys stuff, sells stuff, there's kind of a back and forth of inventory. So that's what we have here. And here's a chart of the buys and sells. So on January 1st, we have a beginning inventory of 100 at 20. On February 14th, we make a purchase of another 200 units. So 200, but we're paying now 2150. That's a cost of 4,300. So the balance of inventory on February 14th after that first purchase is $6,300. We're now going to make a sale of 220 units. And since we're using FIFO for this example, we're going to use the beginning balance first. So that we brought forward 100 units at 20. So that comes in here. And we sold 220 units. So now we need to take 120 at 2150 for total COGS of $4,580. That's our first sale. So the balance of inventory after this sale is 80 units at 2150 because we had 200, we used 120 here, these are gone. So we've got 80 units left at 2150. On June 21st, we buy some more. We get 160 at 2250 a piece. So that's 3,600. So now our inventory on June 21st is what? Let's see, for 5320. On August 18th, we sell 100 units. Well, we're going to use the 80 first from the balance forward, 80 at 2150, and we're going to take 20 out of this purchase at 2250, gives us $450. So our total COGS for the second sale is $2,170. So are we seeing how this flow goes? And remember, we're using FIFO here. On September 2nd, we buy 280 more, and now we're paying $2,350, and our inventory after that purchase is $9,730. Yeah, I can do that in my head. Always been able to do it. Simple numbers, yeah. Okay, and now November 10th, now we're making a big sale, 330 units. So the first ones that go are the 140 left over from here. And we still need 190 more. So we're going to take 190 out of this purchase at $2,350, and our COGS is $7,615. We have remaining in inventory 90 units, right? Because we had 280 minus 190. So 90 units at $2,350, and ending inventory is valued at $2,115. Our total cost of goods sold is going to be these three, or $14,365. So that's the way it looks in a more normal situation in a merchandising business where we're buying and selling and buying and selling. And we're given a specific example of this first sale for $4,580. Now we had a total of 650 units sold at $30 a piece. So that brought in $19,500. Our total COGS was $14,365, giving us a gross margin of $5,135. Anybody want to tell us what the gross margin ratio is? Think about that. Divide the gross margin by sales. And I'm going to do it right now. So dividing $51.35 by 19,500 gives me a gross margin ratio of 26.3, which means I spent 26.3% of the sales to pay for the goods that were sold. That leaves me $5,135. or 26.3% of sales to pay for expenses and profit. Now we're going to look at an interesting concept called lower of cost or market rule. Now we talked about assets earlier on, and we said that when assets are purchased, they're recorded at cost, and we don't change them. Remember we had that example about the land that was valued at the end of the year at more than what we paid for it, and we said we don't change that. Well, inventory is a little different. Inventory is carried at lower of cost or market. So we can do lower of cost or market either at the individual inventory item, major classes or categories of inventory, or the whole thing. It's called aggregate. We have an example here, of course. In item A, we've got 320 units. They cost us $21.50. The market price at the end of the year when we're doing this is $22. So according to lower of cost or market, we're going to use the cost, the original cost that we paid. So cost was $6,880. We're going to bring that over here into this right column as well. For B, we had 460 units, $18 cost, $16 market price now. Obviously lower of cost or market. We're going to use the market price here. So we're going to take this 7,360 and move it over to the right column as well. We can do the same with C and D. So we're getting a total cost here of $30,020. That's what we paid. That's the value on the books of our inventory. The total market cost or market value is $29,120. And the individual item comes to $28,410. This is the aggregate. So if we're going to use the aggregate, we're going to have to say, well, we paid $30,020, but now it's only $29,120. We need to mark down our inventory to $29,120. That difference is going to go into cost of goods sold, marked as inventory loss, and a credit to inventory. Because remember, inventory always has to reflect the value of the inventory that we have in stock. Now, if we were going to use the individual item method, then we would mark down inventory from $30,020 to $28,410. And here's where it is on the financial statements. The assets and the stockholders' equity are marked down by $16.10. And income statement expenses are increased by $1,610. Now, let's talk about fraud a little bit here. Let's say that the manager of the warehouse determines or does the ending inventory value. And let's also say that the manager's bonus is based on increased profits, increased net income. Well, if the accurate inventory is this, right, with an ending inventory of $3,000, COGS is $7,000. Now, if the manager reports an overstated ending inventory of 4, in other words, he lies, he reduces COGS to $6,000. So ending inventory is overstated. Cost of goods sold is understated. So how does that affect the financial statements? Well, all things being equal, understating COGS overstates gross margin, which will overstate net income. And and overstating the ending inventory will also overstate assets. And because you're overstating net income, you're also going to overstate retained earnings. So you're affecting both the balance sheet and the income statement by fraud. But of course, because there was a higher net income here, that manager also gets a higher bonus. All right, next we're going to look at the gross margin method. The gross margin method says if you need to calculate the value of ending inventory in the middle of the year, and you're using a different method for inventory valuation, it becomes a little complicated, but we have a simple method to do it. So one, we're going to calculate the expected gross margin ratio using the prior period's income statement. Remember, I asked you to do the gross margin ratio before. We actually did it, right? Gross margin divided by sales. So if you take a historical gross margin ratio and then multiply that historical gross margin ratio by the current period sales, you can estimate the amount of gross margin. If you can estimate the amount of gross margin, you can estimate cost of goods sold. And if you can estimate cost of goods sold, you can estimate ending inventory. And we're going to take a look at a schedule that's going to show that. So if we have beginning inventory of $5,100 and purchases of $18,500, that gives us goods available for sale of $23,600. Now, if we have sales of $22,000 through June 30th, and we have a historical gross margin ratio of 25%, we can multiply that 25% times the sales and get an estimated gross margin of $5,500 as of June 30th, not the end of the year. Subtracting the gross margin from sales will give us an estimated cost of goods sold, because remember, gross margin is sales minus COGS. So if we know sales, if we have sales and gross margin, we can estimate cost of goods sold. Subtracting estimated cost of goods sold from the total goods available for sale will tell us what is left estimated. Now we're going to look at a couple of ratios that are used with regards to inventory. The first one is called turnover. And essentially what it measures is how many times in a year did we completely sell the inventory. The way we measure this is we take the COGS for the year divided by the average merchandise inventory. So once we have that, we can then, a more important number, we can determine what's the average number of days to sell the inventory. We can take that inventory turnover number from here, plug it in here, and divide it by 365 days. Other things being equal, the company with the lower average number of days to sell inventory is doing better, because the faster you sell your inventory, the more you get your profits, the more you're running cash into the company. And that's an important thing. And that takes care of chapter 5 for us. Again, please make sure if you got questions, come talk to me.